Good morning, everybody. Welcome to our webinar today on U.S. exit tax, Tax 101. I'm joined today by Zhao, who's a senior manager in our Calgary office. Good morning, Lei.
Good morning, Krista.
Just a few housekeeping items first. If you have some questions throughout the webinar, please use the little box you'll see at the bottom called Q&A. We have Efferlin, who is our senior manager out of Edmonton, on the call that will be moderating the questions, and we'll revert back to those at the end of the webinar. As well, at the end of the webinar, when we're done, you're going to receive a link for a survey just to give us feedback on what we can do better, any topics that you're looking at us participating in the future, anything that you could provide us. And finally, if you require closed captioning, there is a button at the bottom, CC, that if you click that, you will get a live transcript of the webinar as we proceed throughout it. So what are we talking about today? What is US exit tax? You know, I think a lot of different countries have a similar type of regime in which when you decide to leave their country of some way or another, there's a US exit tax or an exit tax that exists. In Canada, we call it departure tax. The US calls it exit tax. Theirs is a little bit different of a system, which we'll get into, just because they always forever tax US persons until they give up their US citizenship or green card or residency, whatever the case may be. And at that point, they're subject to this exit tax. So we're going to go into who exactly is subjected to exit tax. There is some limitations on who is subject to it, and there's also some exemptions as well. What is a covered expatriate? That becomes a very important terminology when determining who is actually subjected to the US tax. How is that tax calculated? What is it tax calculated on? Is the other area that we're going to focus on, as well as actually the formalities of how to renounce your US citizenship and or relinquish your green card holder. I guess not and, because you would either be a citizen or green card holder, so it's not a and, it's a or. But there is a different process for both of those. They're not the same process that actually takes place. And finally, just talking about a little bit of tax filing strategies if you are planning to renounce, are there any strategies available to avoid the exit tax? Or if you're non-compliant, what to do? And also, after you relinquish, are you required to continue to file to the US? So those are the areas. It's very full. As you probably know, we've started to break down our webinars into little micro things that intend to explode as you walk through them. So hopefully you find this helpful. And again, if you have questions, please make sure to use the question and answer feature so we can revert back to those at the end of the webinar. So moving forward, what exactly is US exit tax? US exit tax is a tax that exists, and there's a couple different ways in which you calculate it. One is based on gains. The other is actually based on the benefit, if you will, the value of a benefit that exists depending on what the different types of assets are. But the one primary thing is it actually exists on your worldwide assets. Now, that means it's not just on US assets, and a lot of citizens who don't live in the US actually no longer have US assets. It's based on your Canadian assets, your UK assets, wherever the assets are in the world, they're considered to be a whole part of your, if you will, estate. So you have to include those in your exit tax calculation. The tax on the gains is up to 23.8%, which is the rate of gains are taxed at is the top 20, or sorry, the top is 20%. So it's either 0, 15, 20, but the top rate is at 20%. And that 3.8 is that lovely net investment income tax based on the Obamacare. And yes, that is applicable to exit tax when calculating it. Now, the interesting thing with this category of assets is there is an exemption. And that exemption here as listed is available to offset any deemed gain that's being included in your income. Also important to note is if you have assets with losses, those losses will offset the gains. So it's the net gain that's includable in your income tax return on ceasing your US residency, citizenship, green card, or whatever the case may be. So I think the one thing that's really important to note there is and we'll talk about this a little bit later, is how do you figure out what the value is of different assets, right? Because I think the gain can be very subjective with certain things, such as you have a private corporation. Well, how do you value that? Real property, things like that. And we'll get into that a little bit later. But the point is it is just on a deemed gain. Now, where income is not calculated on a deemed gain is deferred compensation. So such things as your RRSP, your RIF, 401k, those different types of assets can potentially create a ordinary income inclusion in your tax return. They are actually taxed at a higher rate because they don't get the preferential gain. They're not treated as a gain. It's a deemed income inclusion of ordinary income. And with this one, again, we'll talk about it a little bit further, but it's the deferral on, it's the benefit that has accrued during such time of being a US person. So let's say, for instance, we're looking at an RRSP. The benefit is the inherent increase in value based on lesser contributions, if you will. So there is calculations that go into it, and it's not always necessarily 100% includable in income and taxed at that 37%. Specific tax deferred accounts, let's say TFSA. Under the Canadian rules or RESPs, where the tax isn't paid on an annual basis, you could, again, those would be includable in your departure or exit return from the United States. And then non-grantor trust tax at 30%. So looking at the value of those. A lot of things when you see these US exit tax, and a lot of the regimes that you see with the US, such as the gift tax, which we've talked about in previous webinars, it's all based on their methodology of estate tax. So they're wanting to make sure that they're getting their value, because in the future, they're no longer going to be able to collect that tax on a person's estate. So they're looking to get, if you will, as much tax out of it at the point that you renounce. So moving on here for Lei, if you want to chat about who is subjected to exit tax.
Thank you, Krista. Thank you for explaining exit tax. It's a very complex concept. So today, I guess a lot of you probably learned that United States imposed an expatriation tax or exit tax to a covered expatriate. What is a covered expatriate, and who's eligible to be considered a covered expatriate? It could be a U.S. citizen who renounced U.S. citizenship, or a long-term permanent resident who has a green card for at least 8 out of the last 15 years, also called a long-term resident. So for a lawful permanent resident, if you hold a green card for less than 8 years before you surrender it, you won't be eligible for a covered expatriate.
And not being eligible is actually a good thing. You don't want to be a covered expatriate.
Correct, yes.
Yeah.
For U.S. citizens, there are some exceptions to being considered a covered expatriate. So the first one applies to a dual citizen who became at birth a U.S. citizen and a citizen of another country, and continue to be a citizen and a tax resident of that other country as of date of expatriation, and was a U.S. citizen for not more than 10 years of the 15 years ending with the year of expatriation. The other exception applies to a minor who expatriated before age of 18 and a half and was a U.S. citizen for not more than 10 years before expatriation.
That one is a little bit interesting. And I think about during our COVID times, the 18-and-a-half-year-old, because you also have to be a certain age before you're allowed to renounce. You can't renounce until you reach a certain age. And so I recall during COVID time, there was some people who wanted to renounce their citizenship, but unfortunately the wait times were so long that they couldn't even get in before they're 18 and a half. So they had to go to different planning mechanisms to ensure that they weren't covered expatriates.
Yes. So if you meet all requirements, you won't be treated as a covered expatriate until you file an expatriate form that we will discuss later, and certify that you have complied with all federal tax obligations for the 5 years before the date of expatriation.
Mm-hmm. Yeah, I think the other thing with respect to this, and a lot of people look at this, and we'll, as you mentioned, we'll talk about it a little bit later in the webinar about possible strategies that can take place with respect to especially the $2 million net worth. We find a lot of people tend to have an issue with that one. And how to kind of get around to ensure that they're not considered a covered expatriate under the exit when they decide to renounce or give up their green card.
Yes. As you can see, there are 3 tests here. So if you meet one of the tests, you will become a covered expatriate.
That's right.
The first one is the average tax liability test. So if your average annual net income tax for the 5 years before expatriation is more than a specific amount, you're a covered expatriate. This specific amount is adjusted for annual inflation. For example, for 2021, it's 172,000. The second test is the net worth test. If the net worth of your worldwide assets, as Krista explained earlier, if the net worth is $2 million or more on the date of expatriation, you are a covered expatriate. The last one is that you fail to certify on the expatriate form that you have complied with all federal tax obligations for the 5 years before the date of your expatriation. So we realize a lot of covered expatriates fail the net worth test of $2 million per person. There are planning strategies to manage your net worth before expatriation in order to avoid exit tax. So since this is a Tax 101 webinar, we won't discuss them here.
Yeah, we'll go into brief. I think the one thing I'm gonna to comment on is with respect to the certifying 5 years of tax compliance. And sometimes we have individuals who come to us and they've filed their 1040s, very basic, but they've missed most of the foreign reporting. So if that's the case, you're not actually compliant for 5 years, and you have to go back and you have to fix that. So merely just filing a standard tax return does not make you compliant. It has to be a complete and accurate filing of a return. So a lot of times we have to work with people when they're going to renounce, and we actually go back and look at the 5 years of returns that they've filed, because if something is missing, they run the risk of putting themselves in this covered expatriate status because they're not actually compliant for the 5 years. And I think, I mean, in our experience, that's where we find the biggest thing, as you said, the $2 million net worth, or they're actually not, their returns aren't correct. It's missing foreign reporting information. Maybe all their income's there, but let's say their trust reporting's missing, or they forgot to file the specified financial account reporting or the passive foreign investment corporation. So there's a lot of, you have to look at the fulsome return to make sure you're actually compliant with all your reporting.
Right.
Yeah.
So the takeaway here is that even if an expatriate meets one of the 3 tests to be a covered expatriate, if they also meet one of the exceptions as discussed earlier, apply to dual citizens at birth or minors, they will avoid covered expatriate status.
That's right. Yeah. And I think you explained it, but I'll just, again, with at birth, it doesn't mean that the day you're born, you immediately receive a birth certificate. There is possibility that after the fact, after you're born, you apply to be considered a citizen of Canada as at birth. That is good enough. That's considered at birth. And it depends on, we'll look at your citizenship card to figure out what type of citizen you are. And that's what determines if you're able to get under this exclusion to totally, and it doesn't even matter at that point how much your tax was, how much your net worth was, or anything, you are going to be excluded from the covered expatriate if you're a dual citizen.
Yes.
Yeah, exactly. So how is the net worth determined? Well, I mean, this is, again, as I alluded to at the beginning of the webinar, it's looking at your aggregate, so your total net value of all of your worldwide assets. So, and the key word there, like I said, is net, and meaning you can take losses against your gains as well. You actually get to reduce it for any liabilities. So if you own a house, but it's highly mortgaged, that's going to reduce the net value of your assets that you hold. That is actually important, because that is potentially a planning strategy of how you're going to ensure that you're moving forward, depending on what you're doing, right? But with the assets, and I alluded to this earlier, is there's a couple different regimes. First is the mark-to-market regime. And this mark-to-market regime is in existence for things such as stocks, securities, partnership interest, private corporation shares, different things like that. And that is looking at what is the value today less the cost to come up with the gain or loss, depending on the asset. And for those particular groups of assets, there's actually this exemption that exists to completely reduce that amount. So if your gain is below that amount, you're okay, because you're actually excluded from including that in your income, which is kind of a, I guess, a win, if you will, depending on how much your gains are. Now, where you can run into a bit of issues is things such as your private corporation, for instance. What value do you pick? Because that could become very subjective. And I know Leigh and I were talking about this the other day, that the IRS says kind of put your best foot forward as best as you can. But what does that mean? You have, in my opinion, I think you have to at least substantiate some way that you've made an effort into determining what the value is of your real property, your private corporation shares. If you have a personal private partnership, generally when you're dealing with public partnership interests and public stock, you can get the value. It's listed on all the trade exchanges. You have that available to you. But when you're dealing with personally held assets, you may want to look at getting some type of basic valuation done, especially for corporations, because I mean, the biggest risk that you run is that you say, okay, my corporation, let's say, is worth $100,000, but really you have this intellectual property sitting there with a $2 million value. Really, you should have said it was worth $2 million. And by having somewhat of a third party substantiate your claim that it is only 100,000 because you've taken a discount valuation or you've taken a position on non-marketability, there's many different ways that you can do it. But if you are able to provide that you actually put in a little bit of effort to prove that the value you've chosen is accurate and complete, less likely that they'll challenge it if they choose to come back. I personally think for those that are really close to that 2 million mark, it's even more important, because you're getting to the point of, am I a covered expatriate or am I not a covered expatriate? And the closer you are to that, the more likely it's going to get looked at to say, oh, you're pretty close. Maybe we can find some extra value here to make you a covered expatriate. So you want to ensure you have your ducks in a row when you're looking at your worldwide assets to figure out the net aggregate value that exists in that. The other part of it is, as I talked about earlier with the deferred compensation, is that net present value. And that is something that you actually have to work with the institutions on to get that information from them to figure out what the net present value is. Let's say you have an employer pension plan, an RPP plan here in Canada. You're going to have to work with them to figure out what is the value today based on the net present value of that or of that pension plan. And once you're able to determine that, you can then figure out what was your benefit based on contributions you made that would be, for lack of a better term, a cost basis, if you will. It's not really a cost basis, but it's not a benefit to you because it was your money that you invested and it's only that incremental difference. You need to figure that out, because it's not necessarily, especially when you're looking at certain pension plans, it's not necessarily the value as it is today, because you're not going to be taking it out for, say, 20 years. So you have to actually look at it with respect to that net present value. And then green card holders as well. There is, depending on how you got your green card, when you got your green card, if there was assets you held when you got your green card, there may have been a bump up in the basis of your assets. And we did talk about that in one of our previous webinars with the election that's able to be made on becoming a US person to increase the basis of those assets of becoming a US person. So there is kind of a lot of different moving pieces that you have to take into play when expatriating. And especially if you're a covered expatriate and over that $2 million, there's a lot of work that goes into figuring out these different values and gains and transactional amounts in order to figure out what is includable in income on your exit tax. So what assets are included? This list, of course, isn't intended to be all-inclusive. This is some examples of different types of assets that you'll find when you're looking to value your net worth. Cash is an interesting one because you could potentially find yourself in a situation with a foreign exchange gain or loss for US tax purposes. Let's say something such as a GIC, where you've put an amount in a term deposit and it sat there for 5 years. There's the chance that you have a foreign exchange gain or loss on that. So you do need to actually contemplate cash when you're looking at your mark-to-market transactions. Stocks and securities, which again, as I said, those are, if they're publicly traded, it's easier to find those values. If it's private, you do have a bit more work to do in order to determine the value of your entity. Pensions, other deferred compensation. It can be through an employer or your RRSP, ESPs, TFSAs, 401ks, all of those different types of things you're going to have to look at to figure out what is that net present value in order to determine what is included in your net worth and what's going to actually be included on your tax return and taxable upon ceasing your US status. Principal residence and other real property. Now, this one's interesting because the principal residence, when you depart, it's treated differently than actually if you sold it. So you have to be really careful on that. And for any US persons out there, you will remember that the US doesn't actually allow to exclude 100% of a principal residence gain. They tax their principal residence. And if you have not been living in the US, and there's certain rules around the principal residence, if you've had to live in it for the past 2 to 5 years, et cetera, but is it even any of it excluded? And under the exit tax, it is actually a different regime that takes place. Partnership and trust interest, we talked about that at the very beginning. If it's a non-grantor trust, we have that 30% rate that we need to watch out for. So, you know, at the end of the day, with all of these, as I go back, yes, you can use some good faith to figure out the fair market value. A formal appraisal is not required, but if you're an individual who has a lot of private assets, you may want to protect yourself if they choose to come back, because you're going to have to show that, what does good faith mean? Good faith needs to show, in my opinion, that you put in some type of effort to show what that value was versus kind of just licking it and blowing air at the thumb, right? I mean, as I said, it just comes down to really making sure that when you're looking at your assets, you're kind of going to be digging in the same way that you would if you're doing an estate plan or if you're doing some type of planning for any other purpose, looking at all of those assets that you hold and liabilities to determine where you're going forward with this.
That's right.
Yeah. So renunciation of a green card, how is it that one renounces? There are multiple different ways for a green card. However, if you are a US citizen and you are looking to renounce your citizenship, it actually is required to be in person at the embassy. I know during COVID time, that was years of waiting potentially to get in and have an appointment, but they have sped up a little bit. We've seen actually quite a few that have come through the past few months where they finally just got their appointments and quite quickly, I think. Well, they waited for quite a long time, but then they're like, okay, you have an appointment in 1 month. So you want to make sure that you're doing your planning in advance, because you never know how quick you're going to get in. And a lot of times I get asked, do I need to hire a lawyer to renounce my citizenship? Now, some people do want to have that comfort of a lawyer to, say, coach them, help them with the forms that need to be completed and submitted to the embassy. But it's important to note that lawyers are actually not allowed to attend the interview with you. You must go in as a sole person and be interviewed one-on-one with one of the officers. Again, a lawyer can coach you. A majority of our clients don't typically use lawyers. There's been a couple that have engaged a lawyer as well as us from a tax side perspective, but it isn't necessary component of actually renouncing your US citizenship. And a lot of what this interview is talking about why you want to renounce. You're obviously not doing it to avoid tax, because that would not be very acceptable to the US Immigration Department. But they're going to talk you through it about why you're giving up your US citizen and where you came to that conclusion and what you want to do with it. And then the green card actually is a little bit different, because you have multiple methods in which you can abandon your green card. The one thing is that's consistent with all of them is the I-407, and that you need to complete with the green card. There is a misconception still to this day that we deal with, people saying, well, my green card's expired, so I'm obviously no longer a US person, and that is not the case under tax law. The only way you're actually considered to have exited the US is if you physically give back that green card to the immigration or at the customs court, border crossing, one of the customs officials. This green card can be mailed in. As I said, you can drop it off at the US consulate, or you can merely go to a border crossing somewheres and physically hand back the green card with the form I-407 and say, I no longer want this, please take this back. And it's at that point that you're considered to exit. There is another situation in which a green card could potentially be considered exited, and that's if you decide to take a treaty position to say, under the treaty, I am no longer a resident of the United States, I am a resident of Canada. That in of itself is considered an exit, and you have to go back through all of those other things that we talked about previously with respect to the net worth calculations and exit tax. The difference with that is you still have to file on an annual basis, and you still have to do foreign reporting. You just don't have to report income and pay tax. That's the biggest difference if you do a treaty position. Where if you actually just give and abandon the green card, give it back, you file your exit tax and you have no more filing requirement for non-US source income. We'll talk a little bit later what happens after you renounce if there's filings required, but that's an important thing to keep in mind. There is multiple different variations with respect to the green card and how to actually relinquish your residency reporting status. Citizenship, it's an in-person interview at the embassy and or the consulate's office, and there's not really much that you can do about that one. That's the only way you can actually, and you have to be a citizen of another country. So you can't be left citizenless. So you must be a resident, or sorry, a citizen of Canada or what other country you choose. But that is necessary before you're actually able to take the steps to renounce.
Krista,
yes.
We have a client who probably got a green card a long time ago, but couldn't find the actual copy or actual card. Can she still abandon her green card?
Yeah. So on the I-407, there's actually places to say, I don't have it anymore. I don't know where it is, but I never gave it back. So please accept this as I'm giving it back, because that does happen. Some people lose them. If they're expired, for some people, they maybe don't become as important of a document. They cut it up, they shred it because it doesn't exist anymore. But on the I-407, you just merely say, I don't know where it is, but please accept this as if I'm returning it.
Okay. Thank you.
Yeah, that's a good point. That's a good point, because if you don't have it, how do you proceed? Yeah, for sure. All right. You want to talk a bit about the US filing strategies?
For sure. Okay, so we already talked about cover expatriate, exit tax, how to calculate exit tax, what are included in the assets. So now we're going to talk about filing procedures. For US tax purposes, covered expatriates must comply with all federal tax reporting requirements in the year of expatriation and for the 5 years before expatriation to avoid being treated as a covered expatriate. We earlier mentioned expatriate form, so now we're going to introduce it. So this is IRS Form 8A54. It's required to file to certifying a tax compliance for the 5 past years before expatriation and to avoid being treated as a covered expatriate and subject to U.S. exit tax, as Krista mentioned before. To bring your U.S. tax filings up to date, you have to file you could follow, there are some procedures you could follow now. So one of them, if you are delinquent tax filers, you could follow the IRS streamlined procedures to file tax returns for the previous 3 years and pay taxes and interest if you meet the requirements, such as if you resided in Canada during the 3 years under these filing procedures and you didn't have a home in the US, you were not present in the US for more than 35 days in any one of these years. Or you could follow the relief procedures that IRS introduced in September 2019. So these procedures actually provide an alternative for satisfying tax compliance for some former citizens, and also provide a relief from taxes, interest, and penalties. These citizens have to meet all the requirements to and also prove non-willful conduct for non-compliance. What is a non-willful conduct? It's generally due to negligence, inadvertence, or mistake, or could be conduct that results from a good faith misunderstanding of the requirements of the law. So now let's talk about the requirements for the relief procedures.
Mm-hmm.
The first one.
Just going back, sorry, one second. If the delinquent and you filed 5 years, it is, like I said before, just because you filed 5 years of tax returns, it has to actually be 5 years complete and accurate tax returns.
That's right.
So merely just filing isn't enough to say I filed the 1040 that was nil and I filed the tax return. It has to be complete, accurate, and completed.
Yes.
Yeah.
Okay, so the requirements for relief procedures. The first one, you have to be citizens who renounced your citizenship after March 18th, 2010. Or if some people thinking about pronounce your citizenship in the future or next year, well, that's one of the requirements. The second one, you have no filing history as a US citizen or resident. What does that mean? So some people might ask, I filed the US non-resident alien income tax return form 1040-NR before because I didn't know I was a US citizen. Well, in this case, if you believe you filed the non-resident return under good faith belief that you were not a US resident, this won't disqualify you from using these procedures. The next one, still net worth test. So your net worth of a worldwide asset is less than $2 million at both the time of expatriation and the time of making submission under these relief procedures. Then the next one is for the tax liability again. So to meet the requirements for these relief procedures, you have a total tax liability of $25,000 or less for the tax years of expatriation and the 5 preceding years, which means you need to have a total tax liability of $25,000 or less for all 6 years you're filing under these procedures.
And that one's actually quite an important thing because when we talk about tax liability, it's not just income tax. It's, as we alluded to, the net investment tax, the tax on the PFIC income, passive foreign investment company tax, that it's all different types of tax. So if you're a person with a lot of investments, you could potentially go over that 25,000 for it because it's the total, not per year, which is a lot different than the 178,000, which is a average annual tax liability under the rules that we talked about earlier. This is a very different procedure that they put in place a couple of years ago, because the amount of renunciations has gone up significantly the past few years. So they've created this new procedure, right, that exists.
Yeah. And also these taxes, not including the exit tax that Krista just mentioned, the deemed gain. And also if you have any withholding tax requirements, this one doesn't include that one either. So then the last requirement, you will have to file all tax returns and required information returns. Like Krista mentioned, you have to file all returns for the 5 years before expatriation and as a resident, and also a dual status return for the year of expatriation. What is a dual status return? It includes a non-resident return for the period of the expatriation year, starting the date of expatriation, and a resident statement for the period of the expatriation year before you renounce your U.S. citizenship. And you have to file the IRS Expatriate Form 8854. To illustrate this, we have a simple example here. So let's say David was born in the U.S. while his non-U.S. resident, non-U.S. parents were attending university. Shortly after he was born, the family returned to Canada. David was a citizen of Canada. David is a citizen of Canada and lives and works in Canada. Then David renounced his U.S. citizen on July the 1st, 2021. David has never filed a U.S. income tax return and has never applied for or received a social security number. His net worth of the worldwide assets is below $2 million. David wants to use the relief procedures to come into compliance with his U.S. tax obligations.
I'm just gonna give me 1 second, like this is just for you guys. We're just talking about this this example. There's no actual laid out. We're just talking about the filings of this.
Yes.
Yeah.
So he must file all the returns and required information returns for the year of expatriation and 5 preceding years before expatriation. So the only requirement he needs to meet now is the total income tax liability.
That's right.
So yeah, if the total income tax is below for the 6 years, if below 25,000 or less, he's eligible to use these procedures. If the total tax is higher than 25,000, he won't be eligible for the relief procedures.
And I think what I say to a lot of people when they're looking at planning strategies, renouncing, and what they want to do, especially those who have already renounced and were delinquent upon renouncing because they thought that their returns were up to date, but they actually weren't complete and accurate. As with most procedures, voluntary disclosure procedures, streamlined procedures, as they're called in the US, they can disappear at any time. So although this got put in a couple of years ago, it could as easily be taken away next year. So whenever we're talking about different filing procedures that are available, as in this example that you gave with David, who hadn't filed, but as long as he's below the income, he can go back and file. That's as at today. I would not rely on procedures for purposes of renouncing. If you have the ability to get your filings done in advance, that is your best approach. It is your best approach to always be clean at the moment, because it is actually one of the questions that they ask. Are you compliant? Unless you're willing to fraudulently state, no, I'm not, or yes, I'm compliant, even though you haven't filed, you need to be very careful. So where a lot of I see this is not people, not necessarily who have never filed, but people who have forgotten to file the foreign reporting for their corporation, or their foreign reporting for, say, they had a foreign branch operation, a rental property in Canada that wasn't reported. That's where this, to me, this really becomes important, this new procedure that they put in place, is because the IRS, along with many other agencies, are really putting a strong emphasis on foreign reporting to try and figure out what tax dollars they're missing around the world. And to me, that's what this procedure is in place for. Because, like I said, when you actually go to renounce, they ask you, are you compliant? And it could be you answered yes because you fully believed in your mind, yes, I filed 1040s and I'm good. I filed my income tax return. There's no more reporting. However, you forgot all of the foreign stuff that was supposed to be includable in that return. And that's where this really comes into play, in my opinion, that you would see this most part. I would not rely on this to say, oh, I have my, I just randomly, I haven't filed my returns, but oh my God, I have my meeting in a month. So I can just ignore filing them in time before my meeting because these new procedures exist. Then you're getting into a situation of your willful neglect. And all of these procedures do not exist if you willfully do not file your returns on time. At that point, when you know you have to do it, but you choose not to, it's very hard to substantiate the argument that it wasn't willfully that you chose not to file those returns.
Yeah, that's a very important point.
Yeah. So as Leigh said, with all of these things, if you're a current US tax filer, if you're a covered expatriate, again, we talked about how do you avoid that with planning, maybe gift some of your asset away to a non-US person or a US person, depending, get yourself below that. But then you're going to have to make sure you have gift tax returns in order to show that, and you have estate tax exemptions available. So there's a lot of different options in order to reduce your value below that $2 million threshold that exists prior to renouncing. And it's planning that needs to be taken into place before you go through with it.
Yes.
Mm-hmm. So I think, go ahead, sorry.
Yeah, so I guess we just want to address that relief procedures only apply to US citizens, not to US lawful permanent residents.
Last one, yeah.
Exactly.
Yeah, it's not for a green card holder.
Yeah, and then if you believe you meet all the requirements, this filing procedures actually save you back taxes, interest, and penalties compared to other regular procedures.
Yeah, exactly. All right, so moving on to our last point here is, do you have to continue to file a US return? The answer is it depends, as is our famous phrase in the tax, it depends on your situation. Every individual situation is different. There is two different types of returns. If you potentially, you gave up your citizenship, but then you end up getting a job in the US and you move to the US under a normal immigration visa that any other person, a L1 visa, let's say, to work in the US, and you become a resident of the US again, you're going to be back filing a 1040 if you move back. That's just because it's based on residency. It's no longer based on your citizenship, but based on where you live in the world. Or if you go over 183 days in the US, but don't actually treaty tiebreak to Canada. So there's many multiple different ways in which you could potentially fall back into that 1040 filing requirement. If it's a non-resident alien, so let's say you're under that 183 threshold, you don't live in the US, you don't spend a lot of time there, but you have, say, rental income, business income, you sell something in the US, or you're opening a business down in the US, partnership income because you've invested in a US limited partnership or US LLC, which don't do that if you listen to our other webinars. But those types of things will actually trigger a requirement to file a non-resident US return, which is a 1040 NR. Potentially even state returns, depending on what the investments is that you've included in your investments. Or you have insufficient withholdings, right, Leigh?
Yes. So for example, if you have the US source dividends from Morgan Stanley, but they didn't withhold 15% of tax on these US source dividends, you will have to file this 1040 NR or non-resident alien income tax return to and also pay additional tax.
Yeah, and I think We see that a lot, even in Canada. One of the things when you're looking to give up your U.S. citizenship is who needs to know, right? It's very important that you actually advise different people, Social Security Administration. If you have investment accounts down there, you have to notify the broker or your investment advisor or whoever you might be working with. If you have a self-funded one, you have to go in and change it that you're no longer a US person, so that they do these withholdings that are actually required of non-residents for investment income. You will even need to know your institutions in Canada, because anybody who's a US person, you've filled out that W-89. Now you actually fill out a W-8 then. So there's a lot of things that potentially change when you give up your US status that now needs to be reported, because the US has its hands in a lot of different areas to collect information. So it's who needs to know. Pretty much anybody that is involved in anything of your financial, your legal, your tax, your accountant. It's important that everybody knows that exists, because as Leigh said, this 15% on dividends, if you don't advise that advisor, they won't withhold. And now you're stuck having to file a return to self-declare this withholding tax. And it's administration that really you shouldn't have to do if everybody knows that you're no longer a US person.
Yes. So after you renounce your US citizenship, it's probably important for you to really make sure if you meet the substantial presence test. So then if you spend 31 days in the current year in the US, and you spend 183 days during the current and past 2 years in the US, you might be a US tax resident. So you have to file a resident return instead of non-resident return. So if you want to learn about more about a US tax residency, you can just find our relevant video on our YouTube channel under Andersen in Canada.
Awesome. Yeah. And I think, as we've kind of gone through everything, there's, everybody's situation is so very different. I think that that's one thing that you really need to contemplate when looking at doing this. It's not a one size fits all opportunity or option. And I will make one slight thing that we actually didn't put on here, but I just thought of it as we were talking about it. If you are a covered expatriate, after you renounce, you potentially still could be in the US tax regime if you gift assets. And that the person who receives those assets, if they're also a US person, there's a 40% tax smack on that gift. So you really need to be careful that it's not always it ends today. When you renounce, you always have to contemplate what you're doing if you've ever been a US person. And if you're a covered expatriate, because once you're a covered expatriate, there's kind of multiple different clamps that can come down on you from the US tax side. Yeah, not just the exit tax as we've talked about today. It's a different subject matter because we were focusing on US exit tax, but it is something to also keep in mind when you're a covered expatriate. That's about what we have for today. We will take some questions, but before people hop off, just remember we are going to be sending a link for a survey to complete at the end of this webinar. If you have anything that can be improved, like me remembering to move the slides forward, sorry for the couple times I forgot to do it, or any other topics that you would like us to cover in the future that is of interest to you or your clients, for those financial advisors that are on the line. We will stay on here for questions for 10-15 minutes here and get to as many as we can. If we don't happen to get to your question, we will reach out to you separately to discuss it with you, or if the question's very specific and we need a little bit more information, again, we will reach out to you to see how we can help you with your questions. So Efferlyn, do we have any questions available?
Yes, Krista and Leigh, we have received a few questions here and we'll try to address some of them live.
Perfect.
So one question is, person looking for clarification on the one of the 3 tests to be considered as a covered expatriate, and that is the $2 million US net worth.
Mm-hmm.
So is this $2 million total market value to be considered a covered expatriate, and then the aggregate net worth is for calculating the tax due upon exit? Or is this 2 million net worth market value minus cost basis calculation?
Sure, I can start, Lay, if you want. The net worth is actually, it's not based on the gain. It's based on the value of your assets minus your liabilities, basically. So you don't take into account the cost basis. Different assets have a different way of valuing, such as the net present value of deferred compensation, whereas if it's stocks, cash, all of that, it's the actual value at the date that you renounced. And then it's less any liabilities, credit cards, mortgages, loans, all the different types of liabilities. So it's actually a net worth calculation to figure out that 2 million. And then for the exit tax is where you bring in the cost basis to figure out the actual gain on the assets.
All right. So another question here is, with the types of financial hate or tax consequences or liability described related to renouncing of US citizenship, what would be the financial benefit of doing so? I believe of renouncing.
You know, I think it's, at the end of the day, giving up the citizenship is not, some people may do it for financial purposes, but there is a lot of times where it has nothing to do with financial purposes, and they're merely just giving up their citizenship to the United States. What is the financial benefit to it? Let's say it's someone who has a startup company that's going to be worth $40 million in 2 years. They don't want to be subjected to the US estate tax regime, which is a tax on value. By being a citizen of Canada, it's a gain tax, whereas in the US, it's a value tax on estate. So sometimes people, in order to future plan, and they don't ever intend to have anything to do with the US, they decide to renounce. Other situations is, we actually see this quite a bit, where someone was born on the US side of the border, so they became a US citizen, or their parents were a US citizen and had lived in the United States for 10 years. So inherently they became a US citizen for tax purposes, even though they never intended to be a US citizen. They decide to renounce because they don't want to have to deal with the annual complexity of reporting all of their assets, all of their income, paying US tax when they really have zero connection to the US. So it's really a personal position. We also have many clients that don't want to give up their citizenship, and they're fine with the annual administration and paying the annual tax to the US because they honor their US citizenship. So it's a very personal decision, I believe, that one shouldn't take lightly, because it is something that is a right of birth for many people, right? So do you have anything to add to that, Lay?
No, I agree. It is definitely a personal choice. So some people want to keep their U.S. citizenship, like you said, and some people just want to just give up it and never file U.S. tax returns again.
Exactly. Yeah.
Another question here, Krista and Lay, aside from lawyers or legal professionals, are there any other professionals you would recommend that the individuals consult when thinking about exiting or renouncing? Maybe like us.
That's right, like us. You wanted to try this one first, Lay?
Well, I think it probably depends on your situation. So if you want to have a legal lawyer to give you advice on when or how to renounce your U.S. citizenship or abandon the green card, you can definitely consult them. And if you need tax advices, you can just come to us, and we will provide a planning strategy if you have the worldwide assets worth more than $2 million. So then giving consideration, maybe gifting some assets to spouse or U.S. children, your net worth will be below $2 million, and so that you won't be subject to exit tax. That's what I think right now. And
yeah, I think, I mean, the other person is your financial advisor, like I said, if you're exiting, because there's certain institutions in the United States that once you're no longer a resident of the US or a US person, it creates a bit of complexity, if you will, because they're not able to do anything for you anymore. So it's important to talk with your financial advisor. You do not need to take everything out. That is not required, although some institutions say that's what's required. It actually is not required. There's ways to work around that. So I would think if you're planning to renounce, your first step should always be to talk to a really good cross-border professional who understands both sides of the border. They generally can connect you, if you don't have a financial advisor, with a good financial advisor that can give you input into how to manage your assets prior to renouncing as well as after renouncing. So I would say, you know, I go back to the good lawyer, the good accountant, and the good financial advisor is always an important person in a life to ensure that you're covering all boxes.
We have a last question here. So husband and wife, husband is a Canadian citizen but has a green card and living in the US. The wife is a US citizen, so the husband is considering whether he should still apply for US citizenship. Is there any added consequence there since he is already a green card holder?
But his reporting wouldn't change. They can do married filing joint regardless of green card, non-resident, or citizen. That's going to come back to, it depends what they want to do with their life. If their intention is to move to the US and be in the US for the rest of their life, then you know, they can do that. It's a lot of this comes around, there's planning that can be done when you're looking to move to from countries for departure tax, because Canada also has a similar regime of departure tax that exists when you leave Canada. So I think, you know, that question is pretty specific, and it's really going to be individual basis of why are they doing it? What are they looking to achieve by getting this? As far as a green card or citizenship, there's no real difference as far as what you're allowed to do in the US. You just can't vote, basically. So it's a personal matter of what the person wants to do and where they intend to spend the rest of their life, and what connections do they want. That really doesn't have much to do with tax per se, because it's the same tax consequences, both of those statuses. Yeah. Awesome. Well, is that it, Efrelyn?
That's all that we have.
Okay, awesome. Well, if there's, again, if there's questions that come up afterwards, please feel free to insert them into the survey and we'll be sure to get back to you. And thank you again for joining us, and we appreciate it. And we look forward to future webinars. Our next webinar will be coming up in a couple weeks. I believe we're doing them every couple weeks now, so stay tuned. Have a great day, everybody.